Well, to alternative assets now, and for a roundup of the year it's been and where it can go from here in 2022. Mark Sherwood from iPartners joining us on the program. Mark, it's great to go and see you. How would you go and describe 2021 for private markets?
Yeah, hi Cara and hi David, nice to speak to you. In terms of alternatives in 2021, a lot of the themes that we've seen this year, David, are really themes that you've spoken to on your AusBiz show throughout this year. One example of those themes would be we've definitely seen higher volatility in equity markets driving greater levels of participation in alternatives. We've seen an increased level of activity in the sector, and I don't think that's any real surprise given it was always likely to be a much more volatile year for equity markets, and particularly given the run-up that we saw in the markets in the last 2 years. And of course, the ending of central bank stimulus was always going to make listed markets more cautious and therefore more volatile. So that has definitely added to the increased volume of investors that we've seen, adding weightings towards unlisted investments this year. Another theme that I would say was very prevalent this year would be that we saw a lot of private credit opportunities essentially expand to be more equity or equity-like opportunities this year. That is providing private debt to some of the emerging and the growing businesses has always been a very active space for investors in the alternative sector. And it's a space, of course, that we've spent a lot of time in and time investing in. However, this year we saw an increase in opportunities to provide equity to some of those emerging businesses. Some examples would be we've done multiple equity raisings for property acquisitions. That is property acquisitions in the regional hotel sector. Major pubs in large towns have seen quite strong demand from a real estate perspective, and that's been a fairly hot property asset to own. So we just closed another equity round just this week for a pub fund that we've been active in all year. So again, we saw quite strong investor interest in that space. And under the same theme of private debt opportunities moving towards being equity opportunities, we've also been active in some follow-on equity raisings for some of the growing non-bank lenders, such as our money market would be an example that comes to mind there. These non-bank lenders are growing very, very quickly and successfully taking market share from the big banks in kind of areas where the banks have been a little slow or a little less competitive in the way that they price for their consumer. So that's been another theme that we've seen in that equity-like opportunities this year.
And Mark, ESG Climate, another big topic of the year. How has that filtered through into alternatives?
Yeah, Cara, I mean, the theme of concerns around the environment and climate change and ESG, obviously we all know increased enormously this year, and that's only going to continue to increase in my eyes. From an alternatives perspective, we've been able to participate in some deals that are looking to achieve that kind of fine balance between supporting the environment but also providing a decent investor return outcome. Perhaps the koala farmland type funds we did a few months back is one of those examples that come to mind. We expect this balance of kind of social and environmental good with appropriate investor returns to be quite an ongoing focus next year as well in 2022.
How are private markets going to cope when we start to see monetary policy normalise? Do you expect to see that continued strength we've seen this year, or is it likely to go and slow down a tad?
No, I think the theme we've seen this year should continue. I think themes like or topics of discussion like inflation is clearly a hot topic globally for the markets, and that normalisation, as you said, of policy. More traditional assets, particularly your listed stocks and your frequently traded bonds, can of course be more price affected through these parts of the cycle, kind of later stage in the cycle that we kind of are here. And the alternative sector really plays a part for those that want to take some exposure to assets that have a set core value, kind of regardless of those inflation environments or expectations around stimulus, etc. So the alternative sector can be very much assessed, or an asset can be assessed purely on its kind of risk-reward metrics many assets or prices not directly affected by those changes and kind of less affected by where we are in that economic cycle. So I think that's the space that gives investors some comfort to add to their or add alternatives to their portfolios, where they can look at assets just purely on their risk reward dynamics and consider them as an exposure that they don't currently have.
Mark, let's take the conversation into 2022. Maybe something that we haven't seen in 2021. Is there anything on your list that you think might be a main theme going into next year?
Yeah, I think a main theme next year will be a lot more activity in the fintech sector, where we're seeing some of the alternate lenders continuing to grow rapidly this year. That's going to continue next year. We're probably likely to see some of these companies move towards institutional level funding, as well as moving into even potentially listing in some cases. So I think the financial sort of sector of private businesses is going to be very, very active next year. Aside from that, I think agriculture is going to be another active space next year. We saw a lot of farming type aggregation strategies this year. That sector's been very well supported by strength in soft commodity and livestock prices. So I think the agricultural sector will see further investment, and that's going to drive more farming type aggregation strategies. So it is varied across the sectors, but definitely the financials from a private credit, private equity, even into listing stage, and I think agriculture will continue to be a big focus as well.
Mark, just to finish off, private debt, particularly when it goes to property developers, what's going on in that space at the moment? Because a few people I've been speaking to have raised caution and a bit of concern about some solvency concerns around some of those players.
Yeah, I think it's a really good point, David. And I think, given what we've seen in real estate asset prices in the last couple of years on the back of extraordinarily low rates, we've seen property prices across the board extraordinarily high. And I think it's fair to say that from here, from a real estate lending perspective, which is really what you're alluding to there, the number of kind of alternate lenders in real estate in this country has expanded enormously in the last 3, 4, 5 years. So I think it's fair to say that any participation in lending towards real estate, it's really a matter of knowing that the group you're working with has a very, very strong balance sheet. And that they can support the project, no matter what happens with the project. If it has any delays in its construction cycle, you want to know that the group has a strong balance sheet to perhaps step in, and that is the first lender stepping in and perhaps complete the project or administer the right people to do so if there was anything to go wrong with the developer. And before that, obviously, there's an important step here to make sure that the developer of the project is very, very strong from a balance sheet perspective as well. So I think in answering your question, I think at this stage in the property prices, I think investor expectations need to generally be lower. That is, the extraordinary returns that we've seen in real estate of the last couple of years are not going to be there for the next year or two. We need to expect slightly lower levels of return, but then we also need to do more due diligence on your lending supplier as well as the developer that's underpinning the development.